facility. Many people have called it the missing link in U.S. rare earth supply due to inter-commercial rare earth production has been about $2 million, so it was absolutely nothing from a capital cost. We have ample processing capacity. Our first objective after we get the Chemours material bedded down is to be 15,000 tons a year of monazite or greater. We can do that very easily with the existing facility. The facility itself has the capability of handling around 50 times more tons per day of uranium ore. So we're only talking about using 1% or 2% of the capacity of the mill. And we have all the capabilities to handle the radionuclides, recover the uranium, and we have state-of-the-art disposal cells designed for 1,000 years, and that puts us in an excellent position. If you look at this initial material we're getting from Chemours, it's about 2,500 tons per year. It represents about 8% of the U.S. current rare earth demand. If we ramp up to 15,000 tons, that would represent around 50% of U.S. rare earth demand, and that is by no means limitation. We can go up thousands and thousands of tons above that, and there is really no limit to how much we can process at White Mesa in general terms. So anyways, we're moving quickly, and watch this space. So the collaboration with the Chemours was our first supply agreement. We signed that in December. Chemours, very well established in Florida and Georgia. And as I said, you know, that is our first brick in the wall here. Chemours is pretty confident that they can you know, double that or maybe 2.5 times those quantities in the short to medium term. So we'll be working very closely with Chemours. And this is low-cost byproduct production from using existing facilities. And as I said, we are very excited about this relationship with Chemours. In addition, just recently, at the beginning of March, we announced an agreement in principle to sell our mixed rare earth carbonate to NEO. We're still finalizing the definitive agreements. And many of you are aware of NEO as a Canadian-based supplier of rare earth oxides and other value-added products. We've got a very strong relationship with NEO and Constantine Karyanopoulos, and basically NEO has agreed to purchase approximately 80% of this initial rare earth carbonate that we'll produce based on the Chemours feed. This is a new slide to the presentation, just showing the relative value of the Chemours feed compared to others like MP, Linus, Aluka, and some of the other aspiring rare earth producers. When you look at the monazite from Georgia and that we're processing at White Mesa, it is very high grade and has a significant basket price compared to others. And it is being produced in the United States, and we have the ability as a company to make the rare earth carbonate. And there is no separation in the United States, as most of you are aware, so it really has to go to Europe or someplace else to take that next step. So this slide just really shows, you know, kind of, you know, the value chain is in terms of on a per ton basis, and we think it's a substantial differentiator to many of our peers in ultimate value per ton of feed in the White Mesa Mill. Vanadium is also one of the legs to our stool. As I said, we have the only conventional vanadium plant in the United States. The price of vanadium is increasing, so we have some significant inventories. We'll look at liquidating that as we can in due course. And it is also receiving more attention for grid-scale battery storage devices for renewable systems. Uranium recycling, we've got decades of experience, or at least the assets of the company have decades of experience in recycling uranium. And over the course of the last couple decades, the company has recycled around 6 million pounds of uranium that would have been disposed of without recovery. and we're very proud of that. But that represents a coal train from LA to New York and almost back to LA in terms of the same equivalent amount of energy from coal as we've been able to recycle from the uranium. So this is a long-term business for us, and it's a very good business, particularly in periods of low uranium prices. There's another opportunity we've been working on advancing for the last 2 or 3 years, and that is the cleanup of abandoned uranium mines in the western United States, but particularly on the Navajo Nation. This slide shows the Navajo Nation. It's kind of the orangey color, and there are a number of red dots, which are abandoned uranium mines that are mines from the Cold War era, from the 50s and 60s, when there were absolutely very few or no regulations for mining of uranium. The White Mesa Mill is the blue star up there, up above at the top of the graph, and we're in an ideal location to assist with that. The U.S. government has collected nearly $1.6 billion in trust, and so we hope to tap into that. We are currently cleaning up a private site, the little green star down there by Albuquerque. That's a private site that we've already taken about 40,000 tons for a fee to White Mesa. Those stockpiles are building up at White Mesa right now, where we can process it and recycle it. So again, this is another leg to the stool, which is quite substantial that nobody else has. Just looking at our financial strength, as I said, we have in the order of about $80 million of cash, securities, or working capital. The working capital does not include the current increases in both uranium and vanadium. If you look in that little table to the right, in that $80 million, uranium is carried on the books at $23 a pound and vanadium at $5 a pound. Look at the corresponding current prices of both uranium and vanadium. So really, in reality, you can pretty much add another $5, $6, $7 million to that $80 million in working capital. We have more inventory than anybody else in the space in the United States. And I can say this, we've produced all our inventory. We haven't gone out and purchased it. We produced it ourselves. So really, in conclusion, before I open it up for questions, who is Energy Fuels? We are the leading producer of critical materials. We have 4 legs to the stool. We have unmatched ability to increase our U.S. uranium production from proven assets, as I showed in that little graph, going back 15 years. We have more facilities, more capacity, and more experience in producing uranium than any other company in the United States. We're quickly moving forward on the rare earth space, and we are moving at lightning speed. So watch this space. We are emerging, and we are going to get to full integration in the United States in the next few years. The uranium reserve, as appropriated, watch this as well. With the government support for critical materials, we are industry leader when it comes to recycling of natural uranium and vanadium. We're well positioned financially, strong balance sheet, 0 debt, and the vanadium inventories and the vanadium auction is still very much there. So now I'd like to open it for questions. For anybody that has questions of me, I'm happy to answer those if I can. Okay, I have a question. It says, what is different at Energy Fuels and in the market today versus what happened in 2006 or 2007 in 2010 to 2011? Well, I think that, number one, I think that there's this growing appreciation that nuclear power is absolutely necessary to reduce carbon emissions. I think that that was the case back in 2006 and 2007 as well. But then you had the Fukushima disaster kind of set back nuclear power. But people have been able to realize that, even though Fukushima was very unfortunate, there were lessons learned, and the world can move forward. And so I think that one of the key differences now is that there's a greater influence in global support for reducing carbon emissions. I think that people realize that we need baseload energy, and this whole electrification and the EV revolution is putting more focus on uranium and rare earths. And I think that Energy Fuels adding the plank of rare earths is a really exciting new opportunity for us. Another question. Gentleman asks, will we be able to process foreign radionuclides containing materials? Yes, we can, and we have a long history of doing that. But our focus is that the monazite material that we'll be importing both in the United States and potentially foreign contains a material amount of uranium that we can recover. And so, you know, it's not waste. It's valuable material. And I think people get confused on the difference between waste and valuable material. So the material we bring into the mill contains uranium that we can recycle the uranium, as I mentioned, the coal train across the United States, so we can recover the uranium. And the beauty of the rare earths is, in addition to uranium, you have these very high value rare earth materials that we can recover as a byproduct. Okay, what is the formula? This is another question. The formula for the sale of rare earths to NEO, it's based on current values of rare earths. It's a formula that will adjust as prices change over a period of time. So it is a sliding scale. And do we expect to make a profit on those sales? Well, the initial quantities from Chemours are small. And so we don't have really significant scale yet. We do plan to increase that scale many-fold from this initial 2,500 tons. We believe with current prices, we'll at the very least break even, but we think we'll make a few $1 million a year off of this initial material that we're securing from Chemours and selling to NEO. The economics are such that as we uprate the quantities and move towards separation and integration, the economics are very, very significant and robust. Here's a question. What are the key milestones for 2021? Well, the key milestones is to ramp up our rare earth production, start moving towards full integration at White Mesa Mill. We want to become known as the rising star in the rare earth space in the entire world. We also are readying ourselves to produce uranium as quickly as possible, depending on how they roll out. The Department of Energy rolls out the uranium reserve or with increases on uranium prices. But our key milestone right in front of us, looking out the next few months, is going to be mainly focused on the rare earths, because the market for rare earths, the pricing for rare earths, is an economic outcome right now. Let's see, another one. Would you expect monazite from other countries, South Africa, Mozambique, for example? Yes, I would expect monazite from other countries. Our first priority is to secure monazite in the United States based on logistics, and that alone is, and the fact the dependency of the United States on other countries. So we want to show that we have the ability to mine, process, and upgrade these materials in the United States. But there are a number of inbounds from people all over the world that now understand that White Mesa Mill has the ability and is ramping up the ability to handle monazite sands from sources around the world. So, you know, we're basically just replicating what the Chinese have been doing for the last few years, and I can tell you it's staggering at the interest we're getting around the world on that front. But we're basically following the same business model. Probably one more. question here. Okay, how much monazite can we process per annum? It is, there's really no limit. We can do tens of thousands of tons in due course. Of course, we've got to secure the monazite, but we believe that we have the scale to ultimately get up into the same production scale of somebody like Lynas. It won't happen overnight. It won't happen in 1 year or 2 years, but we think we have the ability to get to those kind of scales. And we think that our capital strike rate is going to be one of the lowest out there in the entire world, both in terms of crack and leaching, which we require very limited capital. I mean, just a few $1 million to get up to scales, even in the order of Lynas. And even when you start looking at things like separations, metals, and alloys, we're on an existing site with 5,500 private acres, substantial infrastructure, substantial investment already made, and we think that our strike rate commercially, both from a capital and operating cost, is exceptional. So watch this space over time. So I think I'm done with my time here. I'm at 31 minutes, so I'll end the question and answer, but certainly still available for any other questions. You can contact me directly at Energy Fuels in Denver. I'm happy to answer any of the questions you may have now or in the future. So thank you very much.
Working with them, there's myself. We also have a CFO, which is Nancy Lacrossiere. Also on our, we have Bob Rice, that's also one of our board members. If we jump over to the capital structure of the company, we currently have 181 million shares out. There's 79 million warrants. On a fully diluted basis, we have 267 million shares out. Our market cap is approximately 48 million shares. We're really focused on battery material mineral exploration. Our projects, we have the Gauntlet Lithium project. It's one of our most exciting projects. We just recently acquired it. I'll be going through more detail as we go on. We own this 100%. There's the Surimeau lithium project, which we just recently we reported that we ended up with we were able to produce 99.99% lithium carbonate, and I'll be talking about that also. We have the Dome Lemieux, which we also own 100%. There's a property in New Brunswick, which we just doing some airborne geophysics, which we just recently announced it, and we also own a property that we have 50%, which is nickel, copper, cobalt. As you can tell from these properties, it's really we're really focused on battery mineral exploration. So when we look at the mining properties that we own, they're mostly they're the Surimeau and the Dome Lemieux in the province of Quebec. The Red Brook and the St. Stephen's are in the New Brunswick province, and the Gauntlet Lithium property is in Manitoba. All our projects are located inside Canada. And on the left side here, you see the Surimeau, Gauntlet, Dome Lemieux, and Red Brook. We own 100% of those properties. So as I get into detail with these properties, I'm going to start with the Gauntlet Lithium property. This is historical resources, so it's very important. It cannot be relied upon. We will be going out there very shortly to start drilling it and bringing this to an updated 43-101. So it cannot be relied upon as 43-101s are relied upon. So what on historical, we do have 9.4 million tons at currently around an average of 1.21%. And the way the dike is, it's a dike that comes across. It's about 2.3 kilometers in strike. We do have multiple high-grade hits on it. You have some of these highlight results of 14 meters of 1.59, 12 meters of 1.49, 6 meters of 1.42. These are all very good. These are all very good numbers to build a world-class deposit. Our goal here is we're starting with historical reserves of historical resources of 9.4 million tons, and our goal is to get this up to a world-class deposit of 15 to 20 million tons. That is an objective that we do expect to acquire. When we look at the long section on this, so this is looking at it on a face, looking at the dike the way it runs across. Again, it's showing that the grades that we're getting along strike, you got 11.28 meters of 1.54%, 14.81 of 1.59. It continues going all the way down to 12.16 meters of 1.49%. We have one of these holes. We have one of these holes that's have gone down all the way to 800 feet. That's 243 meters. We've got a strike length. We've got a strike length coming across of 2.3 kilometers, except for one hole. Most of these holes have all been down to about 200 to 300 feet. Open pits, you can go all the way down to approximately 900 feet. So there's lots of room to grow this deposit. As you can tell, between where there's the deepest hole, the left side and on the right side, there hasn't been much drilling on, and that's where we're really expecting to grow this deposit. So then I'll get into the next property, the Surimeau lithium property. It's in Quebec. It's not too far away from the Nemaska property. It's about 180 kilometers north. The main town where there's a lot of infrastructure is Surimeau, which we're about 120 kilometers north of that. This property has been very exciting. So we bought this property in December 2017 from Nemaska Lithium. We've done some drilling on the property. We've gotten some really good results. We've had hole intersections of up to 2.98%. We've had multiple intersections at least a 2% and higher. In the past, Nemaska had already spent over $2 million of work on this property. It's actually one of the highest grade lithium deposits in the world. This is a map of our project where we have two zones. We have the number 5 zone and the east zone, and I'll go into a little bit more detail on them. This is just showing the infrastructure that's in the area. There's lodging, there's hydro nearby, there's road access. It's got really excellent infrastructure. We're looking at this property from the air. It's just to show how big this dike actually is. It's quite impressive. Again, we're going to have to go back in there, drill it. When you look at this number 5 dike from a close-up, we did this when we did a property tour. It's quite exciting. Really looking forward to going back on this property and drilling it. What we have done is we've done metallurgical results, and so before I start talking about the metallurgical results, you can look at some of these drill hole results. These were pretty good. Some of them were 1.62%, 1.22, 12 meters of 1.22. This was all the makings of a potential world-class deposit. The grades are very good. This is our eastern zone. This is the dike that's on the eastern zone. Also very good, very nice dike. Needs to be grown, and that's going to be done with drilling. So we've done on the east zone. We've done some channel sampling. Again, very good results. 13.5 meters of 1.85, 11.7 of 1.58, 14.6 of 1.23. We had some 4.4 meters of 2.24. Really exciting numbers. The resource here is a little bit smaller. There's just a little bit over close to 300,000 tons between measured, indicated, and inferred. Drilling is what's going to bring this up. Again, these are historical numbers. We cannot rely on them. We'll be going back there. We're going to be drilling this project, and we'll take it up, and we'll take this thing back up. These are going to be some of the numbers of the metallurgical work that we've done. It's been quite exciting being able to get 99.99% lithium carbonate. You can actually command a premium when you're able to get this high of purity. What you need in batteries is you need high purity raw materials that goes into it. Now I'll go to our copper asset. This is the Dome Lumiere asset. It's so the property location. It's in Quebec. It's in the Gaspé, what we call the Gaspé region. This is right at the mouth of the St. Lawrence River, which becomes the Atlantic Ocean on the eastern coast. So the Dome Lumiere project, it's a large land package. We have over 12,714 hectares. It's like 127 square kilometers. It's in the Gaspé region. It's 32 kilometers next to the town of Saint-Anne-des-Monts. Easy road access. You get there by highway. You go through a park, and then you just come down onto the project. It has a rich history of low grade and high grade lead, zinc, and copper discoveries on the package. So this land package has never been consolidated into one company. This large land package in the past has been with a lot of different companies. So we were finally able to assemble all this under one company. That's what we're really excited about this. There's been some historical drilling, including by Noranda SOCAM, which is a state-owned company, and they've had really interesting, significant values of copper, zinc, and lead. Vision Lithium is now we've completed a 3D compilation on this thing. We've got the modeling done. We put together all the historical data, and we're ready to drill it. This project will. We'll be announcing a drill program sometime in late May, early June. This is the regional geology. This is really interesting to look at. You've got the Gaspé copper mine, which is approximately 40 some odd kilometers to the east of us, and you've got our project is just west of that. Very similar geology. The Gaspé copper mine, when it was in production, they were able to produce 140 million tons at approximately 1%. Our drilling program, we're going to be targeting the same type of geology. These are already some of the proposed drill hole locations that we're going to be drilling. Very prospective for us. We're going to be targeting mostly the copper right now. And then there's we've got the St. Stephen project, which is in New Brunswick. It's a nickel, copper, cobalt project. These are some of the historical zones. There's historical values. We own this 50%. It's a joint venture with another company. And I guess this is going to be, so when you look at the exploration opportunities in our portfolio, really important. So our main one that we're going to be working on is going to be the Godbless center claim. The ground review and reassessment, when you look at it, there's the 15,000 to 20,000 meters of diamond drill program that we're going to be doing. We're going to be trenching dikes. We're going to be trenching the dikes around there and sampling them about every 100 meters. And our target is going to be to get a new resource estimate on this property. So we're going to be on the outer claims. We're going to be doing reconnaissance prospecting. We're going to end up doing a LiDAR survey, a MAG survey, and on the other property portfolio, the Surimeau project, which is also very important for us. We're going to be doing some ground prospecting on the new 131 claims that we just recently staked. We'll be doing some trenching and stripping for new discoveries on the property. There's numerous dikes that we're going to be evaluating them for lithium mineralization. We're going to drill at least 1,000 meters on the non-core major dikes, at least another 2,000 meters on the main dikes. That would be the number 5 zone along strike to increase the strike. As you increase the strike, you'll be able to increase the resource on it. And we're going to be putting at least 1,000 meters on the eastern zone. On the Dome Lemire copper property, we're going to put at least 4,000 meters of drilling. We're going to be doing it on the deep gravity CSAMT geological models. It's going to be a porphyry spartan copper mineralization, 4 to 6 holes, 800 to 1,000 meters. Our other property that we have also the Red Brook nickel cobalt copper cobalt. We've just completed the 900-kilometer airborne MAG-EM survey. We're waiting for the final results on that. As we receive the results on that, we're going to be announcing it, and we're going to be doing a follow-up. We're going to be doing a follow-up with we'll do a follow-up drill program for at least 1,500 meters. And the St. Stephen property, we're going to be doing some sampling. We're going to be doing some sampling on the property to move that forward. But the main assets that we're going to be really concentrating on is going to be on the 2 lithium assets, on the Surimeau, on the Godblitz property. The Godblitz. What's great about the Godblitz is it's already advancing. You're starting with a historical resource of 9.4 million tons, so you want to take that to 15 to 20 million tons. So that's going to be a lot quicker to take it to a world-class deposit, 43101 deposit. We do have to sign an exploration agreement with the Mantis Seabee Cree Nation. It's going to be a very important agreement. We're working on that. We're currently working on that. And the next one is going to be the Surimeau and the Dome Lemire. The copper asset for us is really important because copper is trading at record levels, and it's something that we want to advance quite rapidly. I thank you for listening. If you have any questions, we still have a good 10 minutes or so to answer questions. So one of the questions is, are we fully financed for all the work we spoke about? We are financed for some of that work. We're not financed for all of that work. At the opportune time, we will announce the financing and to continue the work. Our last financing, we had raised $1.6 million. Which should get us a fair amount of work, but we will make sure that we're fully financed for all the exploration work. Just looking at other questions. So one of the questions is, does Vision have any upcoming deals to supply minerals to an EV company in the near future, or is that too premature? One of the things that you do in this business is start early on. Do I have any at this moment? Absolutely not. Are we starting and have started negotiations? Yes, absolutely. We have started talks. Our material is the raw material. That raw material gets processed into a chemical. Has to be processed in a chemical plant to become the final product that goes in. Just like we did with Surimeau. We went from the raw material you get from our property, and then you take that to a lithium carbonate or a lithium hydroxide, and it's something that it's something in our plans that we look forward to doing in the future. And I'll be looking if there's other questions. So you have one of the questions, you have all the permits, and how is it with the First Nation? So the First Nations so I can go project by project. Godblitz. So the Godblitz project, that's the lithium project in Manitoba. We are currently in negotiations with the First Nations. Other companies are currently in exploration programs around that area. So we have to enter into an exploration agreement with what they call the MSCN, which is the Mantisipi Cree Nation. As soon as we conclude that, we can go out on the Godless property. On the in Quebec, we abide by all the rules that we have for First Nations. Everything's been approved, so we can go forward immediately on the Surimeau and the Gaspé, and also on the project in the Red Brook project. We can move on and work there immediately. Sure. Can you speak about surrounding infra? So the next question is, can you speak about the surrounding infrastructure for your project? Sure. So if I look at the Godless property, it's in a town called God Lake. In God Lake, there's electricity about maybe 4 kilometers from our site. There's a town there. There's an airport there. The road to the big cities are by winter roads. There is an environmental assessment going on right now to place roads from God Lake to other cities. It's on the main site. When I look at our copper assets, you can access it by when we talk about infrastructure, you can access it by highway. You drive right to the property. Infrastructure is pretty good to most of our projects. So another question is, where are you headed first, and when do you expect drills to be turning? So the one where we're permitted and we can expect drills to be turning quite rapidly is going to be the project in Gaspé, the copper project. I expect drills to be turning there in late May, early June, the latest. That would be the first one. Red Brook, we're waiting. That's the one in New Brunswick. We're waiting for the results to be coming from there. As soon as we get those results, drills could start turning there immediately. Also, sometime in May or June, or it could also be earlier. So the Godless lithium property, I need to negotiate with the Mantisipi Cree Nation first. As soon as those negotiations are done, then we could proceed further. On the Surimeau project, we're already drill ready. We haven't planned yet when we will start drilling it, but we do have our targets are in place, as well as the targets are in place for our copper asset. So we'll go look at any other. That's when our drills are going to be turning. I'm just looking if there's any other questions. So the key milestones for 2021. So the key milestones for 2021. So let's go property by property. So on the Godless property, it's to sign a exploration agreement with the Mantisipi Cree Nation, start drilling the property, and announcing a 43-101 compliant resource that would be for myself I would consider a world class deposit. We're definitely starting from a good spot when you have a historical resource of 9.4 million tons at 1.21%. For Surimeau is to identify new places to drill the property to increase the resource, and same thing there to bring it to a 43-101 compliance and increase the current resource. For the copper asset is making a brand new discovery. So starting to drill there, making a brand new discovery, and along with the Red Brook property, that's the copper property that's in New Brunswick. Would be the same thing there. And just looking for other questions that are on. And I just want to add that we are permitted. We are permitted for drilling. One. Okay, so I have one other question here that says, when do you start mining the properties? When do you start mining the properties and making money? We're a mining exploration company. How we make money is by I mean, one of the ways that we make money is making a discovery, building it to a world-class deposit, and that's usually when a major comes in to buy you out, and it makes money for the shareholders. That's we're out here to bring in shareholder value. That's how we bring in shareholder value. That's how a mining exploration company does it. So we got one more question here. Was the exercise price on the warrants and the last financing? What was the call price and the forcing exercise of the warrants, and could you use that? Yeah, we could use as if and when warrants do get exercised. Yes, yes, we can use that. That would be cash that would come in. We'd be using the financing that was done on that one was the $1.6 million. We would be using that money for exploration. That's what we're currently using it when we did the Red Brook asset. That's what we used to do the airborne geophysics. The exercise, so they are in the money. They're currently at 5 cents. The exercise price of those warrants. And yeah, looks like there's not many. But we're very excited to start our exploration programs, go forward, turn these assets into world-class. That's the potential that these assets have, is to turn them into world-class assets. And I thank you very much for everybody for attending this conference. That'll be it for today. If anybody has any questions, please feel free to send us questions on any of your further questions over at info@visionlithium.com. I really thank you for attending our session.
Hello, and welcome to Virtual Investor Conferences. My name is Matt Lateplo, and on behalf of OTC Markets, as well as our co-hosts, Murdoch Capital and TAA Advisory, We're very pleased you have joined us for our next live presentation from Electric Royalties. Before I introduce our speaker, a few points to note. Please submit your questions in the question box at the bottom left of the slides. Once the Q&A session is ended, don't log out. You will automatically be transferred into the Electric Royalties booth where you can continue to ask questions via chat and access additional shareholder materials. On a final note, all of today's presentations will be recorded and available for 24/7 replay. At this point, I am very pleased to welcome Brendan Urich, CEO and Director of Electric Royalties Ltd, which trades on the TSX-V under the symbol ELEC. Welcome, Brendan.
Thanks for having me. Appreciate it. So I guess I'll just kind of dive in then. Our company is called Electric Royalties. We are a mining royalty company, and we are the only mining royalty company out there focused exclusively on the entire suite of metals required really for the drive to decarbonizing the global economy and clean energy here as we move forward over the next couple decades. So we are targeting lithium, manganese, zinc, copper, nickel, tin, graphite, cobalt, and vanadium. All of these metals have exponential growth forecasts, across basically renewable energy, energy storage, electric vehicles, and batteries as we move forward. We've built a very experienced management team that includes founders of previously successful royalty companies, including International Royalty Corp, which sold on to Royal Gold for about $700 million, and RE Royalties, which was a new niche royalty company that started up in the renewable energy space, and they've managed to put together about 90 royalties over the past 3 years. And so the opportunity here is really to acquire royalties on the mines that will supply end users in the renewable energy space and electric vehicle space here for the next several decades. Moving on. So this is the interesting thing. So I mean, not only at this point, is this mandated by governments globally, but as part of the COVID-19 economic recovery, it's practically funded by governments now too. And if you can see this, little chart here in the bottom right-hand side, this is basically, the end of fossil fuels and the transition away, to clean energy as we move forward. If you look at this next slide, so not only is that electric vehicles, which gets quite a bit of attention, but that's also in the energy storage space as well. You're going to need a lot of, batteries and to hold that power, from renewables and stuff as we move forward. And so you can see this type of growth profile, and where we're at today, is basically day one. And, same in the electric vehicle space. If you look at where we are again today, 2020, this is just the start of this revolution. And you've got China behind this, aiming to get, 7 million EVs annually in terms of production by 2025. Germany, Holland, Norway, India, even the U.S., as Biden recently won the election, clean energy by 2035. France and the U.K. Banning the sale of petrol cars, diesel cars. So not only mandated by governments globally, but, you're also seeing this funded, as part of the, $2 trillion infrastructure program in the U.S. as an example. And so, we're really excited about this. We see kind of a, 2 decades opportunity here. And how does that really impact us and what we're targeting? If you look at here, this is a good little chart, little infographic. These metals that we are targeting are really critical, quite frankly, for the electric revolution. Lithium, being involved in electric vehicles, battery storage, energy grid storage, manganese, zinc, each of these playing a very key role, in this over the next several decades. Why is that exciting? Well, this is an entirely new wave of demand that's hitting all of these different metals all at once, and it's the first time in human history, where you've seen something like this. A lot of these markets are relatively small markets. They have not received a huge amount of capital investment over the past 10, 15 years. And if you look at the space where we're basically replacing the oil and gas sector over the next kind of 30 years, the amount of capital that has gone into the battery metal space, is maybe about 1/100th of what goes into the oil and gas space. And so, there's going to be a significant amount of capital that's going to need to move into the space. And really the interesting thing here is that mining, unlike any other sector, is probably the most inelastic sector out there. And so, if you tell me that you need more, let's say copper today, fine, okay, I'll go poke a drill hole down. I found some copper. It's going to take me 15 years, though, on average, to actually get you copper that you need today. So that's a real long, gap in terms of timing. So, it's very, very difficult to, go ahead and try and fix issues in the supply pipeline. And because you've had such a significant amount of under capital investment, the supply pipelines for all these different metals are very thin. And what that means is really higher prices across the board. So, very excited about the demand forecast and the, pricing outlook across all these metals. This is a great little chart. This bottom one here was actually put together by Glencore. And, if you think about all the attention, for example, that copper gets, it's interesting to note that, on a relative growth profile, zinc and cobalt and nickel are all going to outpace copper in terms of relative growth. And so, you're looking at, zinc is maybe not the best known electric metal, but, actually significantly impactful in, wind technologies for renewable energy. And, the only bet I really make in this space in terms of where battery chemistries are going to go and where technology is going to go is that we're always going to try and use the cheapest metal. And so, I think you're seeing that in the zinc space right now. And, over the past 6 months, there's been a lot of, technologies in the energy storage space and the battery space, primarily in and around zinc. And, because it is a cheaper metal, there to be some obvious cost savings, in certain applications. And so that's why these technologies are going to evolve to basically try and capture, that difference in value. And so, really across the board, you're talking extremely, high growth profiles where, production will need to triple, quintuple even over the next 10, 20 years. And so we really like this as a, we've kind of got 2 decades runway, which is, pretty rare to see in any opportunity. For those of you who aren't really aware, the way that we're playing this is as a mining royalty company. So the royalty company business model is the best we've come up with to date in mining. It's been proven to outperform mining companies and the underlying commodities associated with them. There's so many great things. I mean, the biggest one would probably be diversification. If you look at the typical mining investment proposition as a single asset junior mining company, it's pretty risky, right? You have a 15-year development timeline. There's a lot of make or break moments along the way where, equity holders can get wiped out. And so, we really appreciate the fact that we can be diversified, not only across assets, but also across commodities as well. We get all the same benefits that a mining company would. So we have leverage to commodity prices. We get, exploration upside, production rate upside, but we have, way less of this disadvantages. We're not on the hook for the development costs. Last year alone, our royalty operating companies, the companies that actually operate the mining projects, which we hold royalties on, raised about $20 million and invested that in our assets, moving those forward and adding value. Our market cap today is less than 20 million. So, that would have been 100% dilution if that was on us. But as a royalty company, we're not responsible for development costs. We're not responsible for exploration costs. We have no holding costs associated with that royalty. And we're not, on the hook for cost overruns or anything like that. I kind of like to joke that I could, spend the next 30 years building out a Rio Tinto, one of the most diversified mining companies on the planet, and I might trade at 7 to 9 times cash flow, where royalty companies are typically trading, 15 to 25 times cash flow. So, same cash flow, but, 2 to 3 times the valuation. The other thing I really like is, you don't need to build out a big team. So G&A can be kept really low. If you look at some of these small mining companies that put a mine into production, they might have to bring 50 to 75 people on, in-house to actually put a small mine in production, and you might be valued in the market at around 100 million. Whereas you look at, say, a Franco Nevada, which is probably the leader in our space, and 25 billion market cap, and I think they only have 25 employees. So, lots of advantages. The last one I'll kind of touch on here. I could talk about it for hours, but royalties are actually generally registered against the project. So we have a little bit of security, as it were. If the management team were to take on the wrong debt package, lose the project, whoever actually picks up that asset through whatever bankruptcy or whatnot, they will actually have to honor our royalty. And so it's a little bit more secure than a typical equity investment. Moving on, so there's a couple ways to acquire a royalty. You can check out the process there on the right. It's a fairly simple process. So when you're creating a new royalty, you're essentially offering an upfront capital payment to a mining company to move that project forward, and in return you'll take a percentage royalty on the project, which is basically a right to a percentage of the cash flow from the mine when it's in operation. And why do groups like this? Well, it's non-dilutive financing, and so with depressed equity price where dilution matters, it might be of interest to a mining company. At the same time, we don't actually mandate or have fixed repayment dates, where groups have to pay the capital back, like in a debt financing. And so it provides a little bit more flexibility, which in mining isn't necessarily a bad thing. There's a bunch of different situations where you might see opportunities in terms of, building out construction, groups that need final feasibility money or money to get across permitting, or potentially a debt refinancing, those types of things. A royalty can really fit in anywhere. It's not, if you have a royalty, it's not like you can't do debt. If you have equity, it's not like you can't add a royalty on. So it really fits in with, pretty much anything. The other side of the opportunity is really consolidating existing royalties. We're probably split about 50% of our time between consolidating existing royalties and creating new ones. If you look at, most of the new royalty groups out there today, primarily they're focused on consolidating existing royalties. And these may be, private landholders that vended projects on to a mining company, or held as non-core assets by other junior mining companies when they sold the project on. And so, basically we're trying to help them monetize that today with some cash and some shares of electric royalties to bring that into the portfolio. So going on to our portfolio. So we've got 12 royalties that we've actually closed on to date, and we have 2 royalties that we are currently acquiring. We just announced about 2.5 weeks ago now our first cash flowing royalty acquisition. And so this is on the Middle Tennessee zinc mine. It's based in the U.S. It's operated by Trafigura, which is a very well-known entity in the mining space. Very large player. They had, I think, about 150 billion in revenues last year, and they've taken over the asset part of a 2019 restructuring of Nearstar. So we're excited about that. They've got about 250 million US earmarked this year for capital investment into Nearstar's assets. And it's really a zinc mining complex. It's got 3 underground zones. There's an exploration project on the site. This is in production today, and it has been paid off about $5 million in royalty revenues over the past 3 years or so. And we're expecting that once Trafigura gets in there and ramps up production, getting over some of the COVID delays from last year, that the royalty should pay off about $2.5 million a year Canadian. And we see about 15 years of current resources in terms of mine life. But the mine's already been producing intermittently over 50 years, already produced over 2.7 billion pounds of zinc. And we fully expect that the exploration potential on this project will see this producing for a couple decades more at least. And so this will be a great foundational cash flowing royalty. It'll basically pay off all of our G&A, leave us with a little bit more capital to reinvest into new royalties, and part of our eventual plan here in the next few years to begin a dividend. So really excited about that. We're going to be announcing a financing in the next couple of weeks to raise the capital to pay for that. And so stay tuned and reach out if you're interested in participating. Alongside that, we've got a very good lithium royalty portfolio already starting to build, primarily in hard rock in Eastern Canada. Our flagship royalty would be the Oche Lithium royalty, and it's operated by Sayona Mining. Sayona Mining actually just got a strategic investment from Piedmont Lithium, which many of you might be aware of, and an offtake agreement. Now, Piedmont is the only group out there right now that actually has an offtake agreement with Tesla for lithium. And so, pretty good strategic partnership there. They're actually in the process of acquiring the Canada Lithium mine right next door. And what that means for us is, we're kind of looking at cash flow now from the Oche project at about 12 to 18 months out. Essentially, the Canada Lithium mine didn't really work out because of the ore body there. And so they really need to blend the ore from another project. And the Oche Lithium royalties, or the Oche Lithium property is right next door, feasibility stage and ready to go. And so, yeah, we're excited about that. It looks like it'll be our, second royalty to come into production. In and around there, we've got a lot of exploration royalties, larger royalties in and around the Canada Lithium mine and the Oche project, as well as the Seymour Lake Lithium royalty, which is in the Ontario camp, where we see another hub forming. And so we just picked that up in February for all shares, actually. It was our first all shares transaction. In addition to that, we have manganese royalties. So we own royalties on about 2/3 of the only manganese project, basically, or district in North America being developed to supply manganese to the EV space and battery end users. And so, kind of crazy to think about when you think about the only district in all of North America, but it's a fairly common theme you see across a lot of these metals. Our focus is, politically safe jurisdictions. Mining's pretty risky. You don't need to bring on jurisdictional risk if you don't have to. And so, we're primarily looking at North America, Australia, and Europe. And when you look at the potential projects that fit or supply domestically across all these metals, sometimes it can be very limited, as is manganese for North America. So we're pretty excited about this. They actually should have a PEA coming out in the next few months. I don't think we get much value in the market today for these royalties, but I think people will be surprised when they see the PEA. The Manganese Battery Hill royalty will actually be we're expecting will be our biggest royalty once actually in production, producing spitting off about $6 million a year, with around a 35 to 40 year mine life. On top of that, we've got a vanadium royalty. This is a PEA stage project, probably one of the best, if not the best, iron ore development project in North America. It's got a 37-year mine life. They're actually in the middle of putting out an updated resource on that project. 37 years was long enough, but we'll take a few more years onto there. It's going to spit off. Our estimate is around $1.5 million a year every year once in production. A little bit further out, but excited about that vanadium exposure. We've also got a graphite royalty. This thing is basically a feasibility stage, ready to go. Had out permits in place, and it's about 10 hours transport away from the largest gigafactory coming up under construction in the U.S. And so, they've got 70 years of resources, 28 years of reserves. Really all they're looking for is an offtake agreement, and they'll be in construction, and cash flow could be 18 to 24 months out. On that one, we're expecting, cash flow will be about $1 million a year, every year once in production. And we are hopeful that, an offtake agreement will be signed in the near future. And kind of rounding out the portfolio to date, we've got some kind of earlier stage cobalt royalties located in Australia, with some options on those to increase them over time, as things move forward there. So we're looking at trying to find, assets that would really be and fit that need for supply of these metals domestically. And so, we're looking for, large assets with long lives. We're looking for the most advanced assets in these jurisdictions, the ones that have the best chance to be the next royalty or next producers of lithium and manganese and graphite for the EV space. And the more advanced, the better. They're ultimately de-risked further, and we blend that with getting in a little bit earlier stage, and you see this tremendous growth in value on those royalties over time as groups advance them. So I won't really go through each individual one, but you can kind of check these out on your own time. Our presentation is up on our website. So in addition to our management team, which I kind of touched on earlier, we've also put together a pretty good group of advisors. I'd like to say that we thought it was prudent to recruit people to help us navigate a very tricky space, and so we rely on these gentlemen to help advise us. Greg Bose has been in the graphite industry already for 10, 15 years. It's been a tough 10, 15 years, but it's experience that he can kind of help navigate some of the pitfalls so we don't make those mistakes. You've got guys like Rodney Cooper, former senior VP technical services at Kinross, Marcel Schlumberger and his father Nick, wealth of family office and private equity experience. Richard Williams, the CEO of Cornish Metals. They've got probably one of the best tin development projects globally in Cornwall that they're moving ahead, so you can help advise us in that sector. And gentlemen like Darcy Marood, former senior VP exploration at Yamana. So, we've built up a really good team. We've got a pretty good asset base here, and we're excited to move forward. Like I said, we've got kind of 2 decades runway here. And we're the only group out there right now that is, focused exclusively on this entire suite of metals. So I'll leave it at that. We've got a lot of questions here. So I'll start with this first one. Do you have any published estimates of your potential cash flow for 2021 and or 2022? No, we haven't put out any guidance on that. Partially has to do a bit with, I guess, regulatory, what you're allowed to say. But, for anybody who really wants to calculate this out, it's super simple. By and large, all of our royalties are gross royalties. And so that's gross revenue. So really, all you need to know is what percentage our royalty is, what the annual production is of the mine that you're looking at. And you can pick a price for that commodity that you think the price will be at. You can use the current price. You basically times those 3 numbers together, and that will give you a sense of annual cash flow that we'd expect from that project once in production. And so it's a really easy way for people to calculate it. We will be putting probably some cash flow estimates out in the near future once we actually close on this first cash flow and royalty. Hope that answers your question. What is the size of current financing, and do you expect to use mostly cash or a combination of stock and cash to purchase royalties? Yeah, so our cost of acquisition is about 2/3 cash, 1/3 shares. In the end of the day, we have been trying to use shares, when we can, as part of an acquisition cost. And really, it's a kind of a win-win because we're offering these groups, continuing exposure and upside to an exciting portfolio, and it lets us maximize, the amount of capital that we have to spend to grow our portfolio. So we will be releasing and formalizing kind of terms on that financing probably next week at this point in time. How do you finance your royalty investment? So, yeah, we've been really good so far at trying to keep it low cost of acquisition, I guess is the way of putting it. To date, if you look at our initial portfolio, discounting these last 2 that we signed, we were paying about 0.05 times MPV. And if you look at the precious metal space, they historically have been paying, even before all these new entrants, were paying about, 1 times MPV. So it's about, our first cost of acquisition was about 1/20th of what they're paying in the precious metal space. Obviously using our shares as, a form of acquisition capital helps. But we have equity is primarily our main way that we would finance these royalty investments. However, as we get growing in size, we are exploring, concurrently, bringing in groups as private equity funds and such as co-investors on royalties to basically allow us to tackle larger, more quality assets without having to put up, a ridiculous amount of capital. We've also been looking at, convertible debt financing options. It's been very successfully deployed recently with Nova Royalties in the space, and also debt financing options. We've had, discussions with multiple lenders on this in the past, and generally they've been, supportive of offering up to 50% of any cash flow and royalty acquisition cost as we move forward. And so, ultimately, some type of debt facility, is typically the way that most royalty companies have gone from, junior to mid-tier. And so definitely we'd be exploring those avenues, as we move forward, and trying to keep dilution low. So I hope that is answer your question. What is the competitive environment for acquiring royalties? Yeah, so I mean, it's one of the nice things that almost all of the new entrants are all focused on precious metals, so gold and silver. Like I said, we're the only group out there focused on this entire suite of metals required for, the global push for clean energy. And so, some of these commodities, we're the only group, globally that's really interested in acquiring royalties or talking to them on these metals. And so, the competition for us is much lower than your typical new entrant to the space. And I would also add on to that, most of these groups out there that have been coming up are primarily focused on acquiring existing royalties. And so, it's a little bit easier to do that, quite frankly. Then you're always competing because it's more of a sales process. I would say that most of our time is spent proactively looking at creating new royalties, and that means, these are original ideas that we've had that we've taken to groups to take advantage of. We see an opportunity where we can add some value and capture that value in a deal. Typically in those, there's no competition because it's a group and it's an idea that we put forward. So we actually feel pretty good about our competitive level right now. But obviously, as people catch on to the upside of this opportunity, we expect that to change. What do you look for in a portfolio company? Well, a couple things. I would say, really we're looking for the asset first, right? Because if we can tie our royalty to the project, theoretically we're making a bet in terms of these projects, are going to be the projects to fill that gap on a technical basis, from deep review. That said, you also want to have a good management team. Management's very important. Ultimately we'd like to work with management teams to help, consolidate each of their respective spaces for their commodities. So ultimately we could be working with, mid-tiers one day. It'd be a much easier kind of business to go. When would shareholders expect dividends to start flowing, and would they be monthly, quarterly payments? So look, I think it's probably going to be 2 to 3 years, if I'm honest, until we actually start, a dividend policy. The reason being that we have some of our big development projects in the pipeline will start to enter production, kind of 3 to 4 years out. And at that point in time, you'd really have significant cash flow coming. In the interim, we are still looking at adding a number of other producing royalties over the next kind of, 6 to 12 months. And so, never say never that we might do that sooner. But I think, right now, given the opportunity to reinvest some of that capital today, the returns will be worth it more over the long run. Are there capital gains as part of returns to shareholders of the project is acquired? There are. Okay, so in case you hadn't, sorry, I went back quickly. Are there capital gains as part of returns to shareholders if a project is acquired? Not really. I mean, typically, you might see us try and make an equity investment in a company, if so they wanted or needed to help move that project along. But primarily, we're in the royalty space. Where you might see some upside to that is, generally, if a project's being acquired, they're being acquired by a bigger company, and so that means more resources, more capital going into that project and getting that project into production quicker. So that is good for us, but no capital gains per se. And I think that's all of the questions we've answered. So, look, I'll kind of put it here. I mean, we've got about 2 million cash in the bank. We're less than a 20 million market cap. Tight share structure. We've got a really, good group of shareholders. Myself and my family are probably the largest single combined shareholder, close to 20% of the company. We've got a pretty good institutional following despite our size, at around 15%. And a really good group of high net worth individuals, that have been highly successful in the mining space. And at our firm valuation of less than 20 million, and you look at our royalty portfolio where we see kind of 100 million NPV, we should be trading at what our base metal royalty peers are trading at, which would be, that's 1.3 times NPV. So you can do the math on there in terms of the re-rating potential that we're expecting as we kind of move forward and get that size that we get that re-rating. And so it's going to be an exciting year for Electric Royalties, and hopefully you join us as a shareholder. And that's our time, I guess. So I will leave it at that. thank you very much. And if anyone has any questions, my contact details are on the final page of the presentation. You know, feel free to send me an email or give me a call if you have any further questions and want to chat.